Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at performance across the globe, including South Africa. We're also going to have a look at what's happening with regards to US growth and employment. We'll have a look at Japanese bond yields. And finally, we'll have a look at the performance of the mighty Rand. We're going to start off with performance across the globe. Last year was categorically a strong year for equity returns. We had global equities up over 20% over the past year, which is pretty high by historical standards. What was interesting about the last year is that despite the Mag 7 and all the developments with regards to AI and the very concentrated leadership of returns in the US actually underperformed the rest of the world. We had very strong returns coming through from Europe, from Japan, from emerging markets. And even though the US returned over 17% in the year, it still wasn't enough for the US to outperform the rest of the globe. And that tied in with a period of dollar weakness. We know historically in times when the dollar has weakened, the US has underperformed the rest of the world, and we saw that play out very neatly over the past year, again, completely consistent with history. We also saw some pretty strong returns from fixed income, both globally and in the US. So it was a very good year for investors. It was a particularly good year for investors that were overweight equities outside of the US, but even those with just US exposure, it was still a pretty good year relative to inflation. And the final point I'll make was that it was still a very strong year for gold too. And it is quite unusual to have very strong returns for equities across the globe and very strong returns for gold. So that has been somewhat unusual. It's hard to see how we're going to get a year like this again, with both very strong returns for equities and returns for risk-off assets. It really has just been a bonanza across the globe. If we scratch a little bit, it is interesting to note that I would say that the primary development over the past year is that valuation mattered. We've gone a couple of years where markets that have been very expensive have done very well. US is a case in point. Interestingly, what we saw over the past year was the countries with the highest starting forward PEs had the lowest returns, and the countries with the lowest starting forward PEs had the highest returns. And there was a normalization of sorts, and valuation mattered over the past 12 months. And I would think that is the key takeaway for the very strong performance across the globe over the past 12 months, is that it was linked, at least in terms of relative performance, to relative starting valuation. So where does that take us? Well, post a very strong rally, most developed markets are now more expensive than the 15-year median, while most emerging markets are still actually cheap. So for the US, for some time, the US has been expensive and it remains expensive, but what we're now starting to see is that some of the other developed markets are now no longer screening as being cheap or fair value. They're now starting to shift towards the expensive side. Whereas across emerging markets, there is still a valuation argument, both relative to developed markets and relative to their own history. Now, looking at some of the macro data within the US, there certainly is a concerted effort from the White House administration to get mortgage rates down, consistent with the whole affordability theme ahead of the midterm elections. The issue is that the current mortgage rate in the US is just a bit above 6%. And there's a large portion of US homeowners that have mortgage rates still below 4%. So as that mortgage rate starts to come down, what we're likely to see is some people who've got mortgages of 2 or 3% will finally be able to afford to move. So we'll see an unlocking of the housing market. But even so, we may well see an increase in effective mortgage rates. In that what will happen is somebody with a mortgage of 3% cannot move at the moment because the current mortgage rate is 6%. But as it comes down to 5%, it might be more affordable. They might be able to, at that point, be able to move. But that still means for that person, the mortgage rate goes up from 3 to 5, even though the latest mortgage rate has come down from 6 to 5. And the point out of this being that as that mortgage rate starts to come down, we may still see the effective mortgage rate for US homeowners tick up over the coming year. And even though mortgage rates come down, we may land up with Americans spending more on their mortgages than they have been doing before. And that's just something we need to keep an eye on within this broader affordability issue ahead of the midterms. Just looking at growth in the US, Q3 growth, the result was delayed because of the shutdown. The number came out, it was well above the consensus forecast, well above what we'd seen before. The US economy in Q3 grew at over 4%. It's a very strong result. And if you look at forecasts for Q4, the Atlanta Fed number suggests that it's running at above 5%. And there is a wide array of forecasts, and we have to wait a little bit to be able to be more precise with the estimate. But it's not beyond the realms of possibility that the US economy is actually accelerating off very strong growth rates. And the question that comes out of this is, why is the job market in that environment so weak? We've seen the job openings are down year on year. And if we look at the non-farm payrolls print, which came out on Friday, they weren't particularly strong. And in total, the US economy in December added about 50,000 jobs. That was below the consensus estimate of 70,000. And if you look at the 3-month average, given the volatility of the non-farm payrolls numbers, probably the best way to look at the US labor market, that series is still negative. And if you look at year-on-year growth, that's looking pretty weak as well, below 1% growth, which is quite unusual outside of recessionary environments. So we've got this very strong disconnect in the US at the moment between GDP growth, which has been exceptional at 4% and maybe even going up to 5%, and labor data, which has been pretty weak. And the Fed's focus up until now has been on a combination of employment and inflation. So they'd be looking at these employment numbers, which are pretty weak, and they'd be looking at the inflation numbers, which have been a bit better than expected, but are still pretty high. And they'd be debating whether to cut or not, and noting, of course, that Jerome Powell is pointing out the political pressure that the Fed is coming under. And what that means is that the extent to which the Fed cuts over the coming year is probably in question. But of the two, between growth and employment, the Fed is likely to be focusing on employment rather than growth. Switching to Japan, we've seen a pretty sizable surge in the 10-year bond yield in Japan. 5 years ago, that rate was at 0. It's now running above 2%. The market's expecting it to drift higher beyond that. We do have to question at what point this is going to become a headwind for growth in Japan, and at what point the BOJ is likely to intervene. And when combined with a very weak Japanese yen, it suggests that there may well be an opportunity within fixed income in Japan. And finally, switching to the mighty ZAR, we've seen some pretty strong performance for the rand. Of all the currencies that we track, it's the strongest performer over the past 1 month, 3 months, 6 months, and second strongest over 12 months. And we think that there's 3 primary reasons that that's occurred. Firstly, an improvement in the fiscal position for the state. The Treasury is expecting debt to GDP to peak this year, and whether it's this year or next year, it's a sizable shift compared to what we've seen over the past decade or so, and actually quite different to what we're seeing across other countries across the globe. So that's, I think, is the first reason. The second reason is an improvement in SOEs. We've seen improvement in Eskom, and actually we've seen improvements in Transnet too, and SOEs are no longer the binding constraints on growth that they were before, and as a result we're seeing SA GDP growth drift towards that 2% number. And finally, the third reason, and a very important part of this, has been the surge in commodities that are particularly relevant for the SA economy, like gold and platinum. If you look at the commodities that SA exports, the 6-month average is up 28% year on year. Very helpful for our terms of trade, very helpful for the rand directly, but also it's very helpful for the rand indirectly in terms of the support that it provides for the fiscus, and hopefully that results in that debt to GDP number actually peaking this year. So the net result of that is that there's been a combination of factors that have led to some pretty strong returns for the rand. So where does that leave us at the moment? We need to recognize that's occurred in an environment where the dollar has weakened. So a lot of the recent rand strength has also been due to a weaker dollar, and the dollar at current levels is still pretty strong. If you think of the potential difficulties that are being raised in the US with regards to executive interference, with regards to the Fed, it's hard to see how that results in much other than a further weakening of the dollar, which would provide further support for emerging markets more broadly, and even potentially the rand. And the rand isn't yet expensive, not by our measure. And just a final point on this, of all the currencies that we track across the globe, the Japanese yen does appear to be the weakest. And that, again, will present itself as an opportunity, we think, over the coming year. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets. An authorized financial services provider and a registered credit provider.